Have you ever wondered if the money you are earning in your savings account could be growing even faster, or if the loan you are taking out is actually costing you more than it seems at first glance? It can be tricky to navigate the world of interest rates, and understanding a couple of key terms can make a huge difference in your financial journey. Let's unlock these secrets together. Today, we are diving into how annual percentage rate, or APR, and annual percentage yield, or APY, impact your money. The simple answer is that APR tells you the yearly interest rate for borrowing, often without factoring in compounding, while APY shows the true annual rate your savings earn or loan costs after accounting for that compounding. APY includes the effect of earning interest on your interest. Let's break that down. APR, or annual percentage rate, is usually the headline rate you see on loans like credit cards, mortgages, or car loans. It represents the cost of borrowing money over 1 year, and traditionally, it does not include the effect of compounding interest within that year. For instance, if you have a credit card with a 16% APR, that is the base rate charged on your balance annually. However, with APY, or annual percentage yield, things get even more interesting, especially for your savings. APY reflects the total amount of interest you earn on an account over 1 year, taking into account how often that interest is calculated and added back to your principal balance. This process is known as compounding. The more frequently interest is compounded, the higher your APY will be compared to a simple interest rate. For example, a savings account with a 4% APR that compounds interest monthly will have a slightly high APY, because you are earning interest on your initial deposit, plus the interest that has already been added to your account each month. This seemingly small difference can really add up over time, allowing your money to grow more quickly. Conversely, for certain types of loans where interest compounds, the APY can reveal the full cost beyond the advertised APR. So, what does this mean for your everyday finances? When you are looking to save money, always compare accounts using their APY. This gives you the most accurate picture of how much your money will actually grow over a year. A higher APY means more money in your pocket. Conversely, when you are borrowing money, especially on loans where interest might compound within the year, consider both the APR and the effective annual cost. For simple interest loans, APR is usually sufficient. But for credit cards or other revolving credit, understanding how interest accrues can highlight the real cost if you carry a balance. Think of APY as your friend for savings and a warning sign for certain types of debt. Understanding the distinction between APR and APY empowers you to make smarter financial choices. You are not just looking at a number. You are seeing the true power of time and compounding at work. This knowledge allows you to confidently compare different savings accounts, investment opportunities, and loan offers. It also helps you spot the most beneficial options for your specific goals, ensuring you are either maximizing your earnings or minimizing your borrowing costs effectively. This is the difference between simply having a bank account and actively growing your wealth with informed decisions. Ultimately, knowing how APR and APY work gives you a significant advantage. Whether you are aiming to build a substantial savings fund or manage your debt responsibly, these two financial terms are essential tools in your toolkit. By actively seeking out the best APY for your deposits and understanding the full implications of APR on your loans, you are taking control and confidently steering your financial future towards greater stability and prosperity.